Welcome back. We are now going to go through some examples of analysis in action using the techniques learned in the course. Remember, a trader is building up layers of evidence, not beliefs or bias, in order to place the trade either short or long. They're trying to find trade setups where the evidence points to where the odds might be in their favor. When doing this, the trader is trying to do two broad things. First, identify the prevailing trend, and second, use technical analysis techniques to confirm entry and exit points. If there isn't enough evidence at either stage, the trader doesn't have to open a trade. They have the luxury of not participating in the market until the time is right. They wait for the market to come to them. I'm going to switch over to the computer so it's easier to show you what we are doing with our first practical example. Hi all and welcome! Welcome to my desk. This is where I do a lot of my trading and also daily analysis. I'm going to be using community charts, but for the purpose of your own assignments and practicing, you're more than welcome to use your own brokerage charting package provided by your trading platform. The instrument that I'll be looking at is euro-dollar, and the time frame that I'll be looking to analyze from the trading entry point of view is in 15-minute, therefore very much short-term intraday time frame. The first thing that I'll need to do is to establish the prevailing trend, which is in our case going to be in an hourly and also 4-hourly time frames. In order for me to do that, I would go into a multi-view. So therefore, I will have a number of different time frames displayed, ranging from daily all the way down to a 15-minute time frame. So looking at the trend at the moment, you can see that I have moving averages already applied on a chart, and the red line is 20-period moving average, blue line is 50-period moving average, and this orange line is 200-period moving average, which is currently pointing to 2050, one spot 2050 in end of day time frame as a major support. From the trend analysis point of view, my 4-hourly time frame appears to be very much downtrending. We can see the sequence of slightly lower highs and a slightly lower lows, and the price action is currently trading below multiple falling moving averages, in our case 20, 50 and 200-period moving averages. 1-hourly time frame appears to be confirming that trend as well. Sequence of lower highs, sequence of lower lows. The price action is currently trading above 20-period moving average, but very clearly capped by 50-period moving average and very clearly below falling 200-period moving average. If I go and check in a 15-minute time frame, I could see that 15-minute time frame price action is rallying, but currently coming to some resistance around 2130, which is signified by this orange line, which is our 200-period moving average. And if you remember, 200-period moving average is absolutely major either level of support or resistance, depending if the price action is above or below it in any time frame, and it should be closely watched and paid attention to. Now, let's go into the actual charts and see if we can identify some levels or additional reasons why some levels might be important for us from the trading point of view. And I'll be using a combination of different things. I'll be using price action recognition, I'll be using candlesticks, I'll be using Fibonacci, I'll be using oscillating indicator to help me identify any of these areas of interest. And you do not have to use the same ones, you can use the different ones, and we'll try and talk about the variations that you can use. But in our case, what we are using at the moment is 20, 50 and 200 period moving averages, and also an oscillating indicator which is called stochastics, set up at 1433 to identify overbought and oversold market conditions. So Let's go into an hourly time frame first, because that'll clearly define the trend and potentially indicate some levels of resistance and support that we should be paying attention to. So the first thing that I would do from the trend point of view, I would identify the sequence of lower highs in our case, and I would draw this trend line connecting this sequence of lower highs and extending it in the future. So therefore, we know that our price is below that falling resistance trend line, and that falling resistance trend line level would be a level of interest that we should be paying attention to. I would also connect this sequence of lower lows and extend it in the future as well. So we can see that the price action is trading in downward motion. It's currently capped by 50 period moving average, and it's also currently capped by this falling resistance trend line in 1 hourly time frame. So just by looking at this time frame at the moment, I can very clearly see that this trading range here in the past was support, 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 and I would identify the lowest level of that trading range, which is in our case very close to 2150 there. And I would plot that level on the chart, and I would identify it as a horizontal resistance area as well. I would also identify this current sequence of the lows, and I would project it down to here, and I would identify that level very close to 2050 as a major support level. And if you remember, the 2050 was 200 period moving average in our end of day time frame. So a couple of reasons why the 2050 is really important. Now, the other thing that I would be keeping an eye on here is I would be keeping an eye on this trading range that played in the past. So this was our support, our support, our support, and once that support is challenged and lost, it becomes a newly found resistance. So what I would do is I would keep an eye on this trading range here. So it's not just one level, it's actually, if you remember when we were talking about support and resistance zones, there's a range of about 15 points between the closing and the wicks, which I would be paying a close attention to, and it's very close to this 2150. So one spot 2145, one spot 2160 area. So major point of resistance as well. Now, let's go into a 15-minute time frame price action and see if we can fine-tune it and find out some levels that we should be paying attention to. So I'll just move this trend line down here and keep it intact so that it becomes visible when we go down to a 15-minute. So we know that that trend line is the one that we were looking at from the hourly point of view. Now, just by looking at this price action here as well, we can see that we have significant swing high and also significant swing low. So I would draw a Fibonacci retracement which will measure this retracement of this overall impulsive move lower. And I can also see very quickly that although the price action is above 23 and 38% retracement, it's currently capped by 50% retracement and also 61.8, which is very close to that 2150 area that we were looking at from the resistance point of view. So what I'll do is I'll color this red and make sure that we know that this is our resistance as well. So suddenly we have multiple reasons why this zone here is becoming very significant level of interest from a resistance point of view. Additionally, just by looking at this price action now, I can see that this potential price action rally against the overall prevailing downtrend, if I connect this sequence of higher lows as a support and connect this sequence of higher highs and project it, is potentially starting to form something that resembles a rising wedge. And we know that rising wedge patterns are continuation patterns, and they tend to break in a direction of the prevailing trend, therefore to the downside, because our prevailing trend in 1 hourly and 4 hourly are currently downtrending. So a couple of scenarios that bearish traders would be looking to benefit from. So the first one would be if we see a rally from these current levels into this resistance zone, therefore 2150 area. Bearish traders would be looking to find some sort of confirmation that this bearish trend is still continuing. So if the price rallies at that level and suddenly creates a bearish evening star formation, candlestick formation, possibly even a shooting star with a big massive wick and a selling pressure with a head closing down within that 2150 area. Maybe even bearish engulfing with a sequence of several smaller trading range green candles with a big red candle engulfing the previous green candle. Maybe even bearish harami, therefore inside bar. Something must happen at this level here to give me as a trader additional confirmation to enter at that level from a shorting point of view. I would just like to show you something else, just briefly going back to an hourly time frame without trying to confuse you. So if we go to an hourly time frame and see something like that happened, then we could see that our stochastics, which is currently sitting here in overbought market conditions, therefore looking for a crossover to confirm that bearish scenario. So if the price does rally into that level and bearish pressure starts pushing it lower, the stochastics will pinch crossover and start moving lower in the same way as it did here, therefore confirming the existence of this downward trend. So there's an oscillating indicator confirming the existence of the trend and looking to additionally confirm the potential bearish setup at that specific level. Now, majority of the people who are looking to short at that level would be looking to enter at that level, and it will be very useful for us to identify where they would likely be putting their stop loss orders as well. So majority of the people who are looking to do that would be putting their stop losses up here towards 2170, 2175. The reason why is it's about 20 points higher above that range, because if the price for whichever reason breaks above that falling resistance trend line and closes above, then it negates the bearish setup and it's no longer resistance, it becomes something else. So then their stop losses would be triggered, and therefore that's the amount of risk that they would be willing to carry, about roughly 20 points of risk, depending where they enter and where the price confirms. The other scenario that can possibly happen from the bearish point of view as well, instead of price rallying into 2150, we could also see a price falling from the current levels below this rising support trend line, and quite often you can see the price rallying from underneath. So previous support, now newly found resistance. There is your support, 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 now tested from underneath as a newly found resistance. And then the price could possibly flush lower. It would also be very useful from the analysis point of view, once we identify the level at which we would like to trade and the level at which we would like to put our stop loss, to try and identify the level at which we would use to put our limit orders, therefore our potential profit taking zones as well. Couple of ways to do that. The first one would be to take the widest point of this trading range and extend it to the downside at the point of entry. So therefore the same number of points as this widest point of the trading range as a potential level at which other traders might be looking to take some profits. And you can see that it brings us to support, 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 support. So if the price does go down to that level, traders would remember that level. It's a round number. We talked about round numbers. It's 1 spot 21. So therefore, some people might be looking to take profit at that level as well. Additionally, a little bit more speculative way of looking at it is from this previous consolidation range here, all the way down to this current low. So that will be a flag pole or a trading range which will take in consideration the whole of this move lower. And then it depends where the price breaks. We could see potential profit taking area very close to these current lows here at 2070. Majority of the other people who are looking to trade this from even more aggressive point of view would be looking at that 2050 zone, which is, if you remember, our daily 200 period moving average. So this zone here would also be seen as a major level of interest by many traders who are looking to trade this from a bearish point of view, because they would be likely looking at that area here to take profits. And if the price does fall to that level, that will give in stochastics enough time to go down to oversold and start crossing over, so which is their confirmation to cover their shorts, therefore buy back again and close their trading position as well. From the risk to reward point of view, about 20-point risk for potentially 100-point lower, so 5 to 1 risk to reward ratio if they do enter at 2150 with a stop loss at 2170 with a take profit of 2050. Alternatively, if they enter around 2130, majority of them will have their stop loss at 2150, so yet again about 20 points higher, with a view to take profit towards 2070 or 2050. So from the risk to reward point of view, the entry would be confirmed by a bearish candle forming, and only if that candle forms and completes in your chosen time frame would additionally confirm your decision to engage with this particular financial instrument in the direction of the prevailing trend. For the example of this analysis, we used moving averages and we used Fibonacci, we used trend lines, horizontals, and we also used oscillating indicator stochastics. Instead of moving averages, you could have used Bollinger Bands, for example. You could have used daily pivots. You could have used parabolic SAR. You could have used MACD to identify the trend and the momentum. Instead of RSI, you could have used, instead of stochastics, you could have used RSI. It's up to you to find a combination of indicators which you can read and you find useful. So, thank you for watching. Hopefully this was informative, and I'll see you in the next example.